All right, Alex, you ready for this one?
I'm super excited, man. Kick us off. Tell us who we're gonna have today.
So this guy, Tad Park, he is our first guest on the pod. Basically, bet the farm. When I mean bet the farm, I mean refinanced his mortgage on his house to go all in on Tesla 2019. This was before Tesla ran up, so it dropped in half. And then obviously we know what happened with Tesla. He took all the money that he got off Tesla and all the options, so he was like overexposed and really had some nice gains, and started his own ETF, which is like
Yeah,
insane.
not just one, a whole family of ETFs, and they're all betting on disruptive innovation in big ways, right? So not just a Tesla ETF. He's got a cybersecurity fund, and he even has an active Bitcoin fund, which is really cool.
Yeah, this is going to be exciting, I think, for people who check out this interview, primarily because we know ARK Invest is out there betting on disruptive innovation, consolidating hundreds of millions of dollars into a few companies. But there's other ETFs that are out there. Now, there's not a lot of them, and that's why it's cool that we found Tad. But Volt is trying to do something that is different in the investing world, and it's why they have these separate family of ETFs. And the unique thing about it is the guy didn't raise any money. He didn't go to private equity funds and raise hundreds of millions. He took the money he got, like a true retail investor, and started his own thing, which is just like insane to me that he did this.
Yeah. Yeah, so he's really living the dream. I'm really excited to have him on. And then hopefully we get to ask him a lot about how he decided to pick just a handful of companies to go all in on and get a first look into a real fund manager's experience on investing in disruptive innovation. So let's make it happen. Let's go.
Hello, everybody, to our second episode of the Catalyst podcast. First time we have a guest, so really excited for Tad Park here to be the guest. He's the CEO and founder of Volt Equity, which is a ETF, and we're really excited to talk to him today about his strategy in terms of allocating capital, investing in companies, what the firm's kind of thesis is behind investing in public companies, and overall the trajectory of where they see the public markets headed over the next couple of years. So, Tad, thank you for being here and being our first official guest on the podcast.
Yeah, pleasure. Thanks for having me.
So, first question we have, we're going to get right into it. What is Volt Equity? How'd you kind of come up with the name? And is there anything special about the current moment in which you started this fund and how you feel the fund is going to do over the next couple of years?
Yeah. So Volt Equity is my company, and we have three different ETFs. So we're an ETF shop, and if I rewind a little bit, just in terms of why I wanted to start Volt, it's because back in 2019 is when I made a pretty critical decision in going pretty heavily into Tesla. So at that time, I had to think through a lot of things. I had to challenge the way that I was investing, the way I normally did things, and I questioned, hey, is it always right to just buy S&P 500 and forget about it, right? And then I thought, hey, that's not what people do. Sometimes people want to start a business. Sometimes people want to take a little bit more risk. And the way I thought about it is when you think about a job, it's you're basically making, you might be making 100K a year. It depends on the person. But if you view that as a bond, right, 100K a year over your whole lifetime, and you just like, what is the value of that? That's like a $1 or $2 million,
Right.
for the rest of your life. So people say, oh, you went all in on a particular stock, that's risky. Oh, you invested in individual stocks, that's risky. But they don't really look at it from your whole portfolio is $2 million. You only put in like 10%, 5% of your portfolio in the future. Is that really risking everything? Like even if Tesla back then went bankrupt, it wouldn't really affect me that much. I could still keep working as a software engineer. It wouldn't have affected my life at all. But if they did disrupt everything, then it would really change my life. And that is how I viewed it. But I definitely had to convince my wife of that. So yeah, that was a very long talk on way more than she wanted to hear about autonomy and how autonomous cars work and why they would be winning. And then right after I invested, the stock tanked 50%. And then autonomy day happened, and the stock keeps tanking. And but through that, the rest is history. That created enough funds for me to launch Volt. So then, in terms of how I wanted to do Volt differently, there's way too many funds out there that basically just say invest in everything and retire at 70, but there isn't enough that basically gives enough exposure to disruptive names. So I wanted funds that were not scared to concentrate on names and wanted to invest in the future and have more of like a VC style mindset on investing. And that's why I started Volt.
I think that's really cool. Yeah, I want to double click on something you just said there. I really think that when it comes to a lot of these disruptive innovators, you're totally right that there's an asymmetric upside compared to the downside. Many of the companies we talk about when we talk about disruptive innovation are micro, mini cap, small cap companies, which means you can get a lot of exposure to them relatively early in their life cycle. Sometimes they wouldn't even be publicly traded a few years ago. They'd still be privately funded. And today they're just able to go public much earlier. So the upside, you can have so much more potential upside over the long term if you're willing to be a long-term shareholder of great companies like Tesla, that you're right. The risk is like you put 5% of what you would make over your career down, but you could make much, much more than that. How do you think you find these asymmetric downsides and upsides? Because I noticed that your funds are really concentrated in a few core positions, and then they have broad exposure to a few other positions to diversify. How do you balance your core positions and the concentration versus that diversification in the Volt funds?
Yeah, I think that's a good question. So different parts of the fund do different things. So some might just be the broad theme, right? If electric cars become a thing, then there's going to be an increased need for nickel and lithium and general miners and robotics and that kind of thing. So that if that thesis is correct, and whoever is the winner, it doesn't really matter. Like it'll probably go up in a certain way until it hits the total addressable market. So they basically are the ballast or kind of like the stable part of the portfolio. And then the other part of the portfolio, that there are like very asymmetric bets. So one example, I don't want to go too much into how I view the Sonder is a very unknown name, but I view them as they're either going to go bankrupt or they're going to go up a lot. It's just my opinion. So if you like held maybe 5% in them, right? Like what could happen, right? It's like definitely this is not something like Tesla where you would hold like 100% unless you're like prepared for that, losing it all. But if you like just imagine if it was like 5% of the portfolio, then what's the worst that can happen in 5 years? You would lose it all. What's the potential outcome if they survive? What if it 20x's? Then that's like 100% return. So if it's like 100% return in 3 to 5 years, it's just that portion contributed a ton to the portfolio. And now imagine you had like 20 names like that. You had a bunch of like these 1%ers, right? Very, very far out. Like basically now we're thinking like a VC. So there isn't that kind of thinking enough in the asset management world. It's usually like everyone holds Google, Facebook, whatever. No one's making an asymmetric bet. And I think that was very frustrating for me is like there are disruptive companies after they go public. Like just look at Amazon, Netflix, like all these different names, they went crazy, and most funds, they only have like such a small percentage in them that it barely affected the returns. And if we thought like a VC and provided like some exposure, it doesn't have to be like really crazy, right? It doesn't have to be more than 5%. And for those kind of names, it could be a new investing style like that people do not talk about enough, especially for high growth disruptive names. Yeah.
In the context of Tesla in 2019, when you went in and then it dropped in half, when you mean you went in, you mean like you bet the farm, like you had to tell your wife, like, hey, like we could go, like how deep were you into the stock to allow it?
Okay, we're about to be eating ramen noodles for the next year, baby.
Yeah. Well, first of all, definitely would not and I recommend this to anybody, but like this was just something that made sense for me at the time, because I was like, okay, I was really into the FIRE movement. You retire early and you just invest in all that stuff. But there's usually people just talk about like normal FIRE, which is just invest in the S&P 500 and then retire at 45 as opposed to 65. But I think, like, what if you just increase the risk slightly and made some picks in stocks, and then you could potentially retire a little bit earlier. And there are a lot of things I thought about too. It's like the equity that I was getting at that company, or actually in tech companies, you take a big pay cut. So you could have been making 150K, you could have been making 200K, right? But you're working at an early stage startup for the equity. So you took a 50K pay cut. In the software world, like, yeah, I mean, I could have been making well over 200K, but then, yeah, I'm basically on peanuts for the equity. So then I thought, okay, there may be other companies that are just as disruptive, and people are basically taking a huge pay cut in order to gain that equity. Then at that time, I thought, okay, the name that I think is going to be most disruptive right now, I look around and I thought, it's Tesla. And it's public. So I don't even have to like join at Series B or Series A. Like I asked my friends who already worked at Tesla, and they basically have just Tesla options. So I thought, wow, they are working like 60 to 80-hour weeks and taking, somewhat of a pay cut, and they have stock options, and like they're doing that. Or I could just, not even do that. I could just buy the stock and the options, and I gain the entire exposure without working my butt off. As long as I know what is disruption, I can gain all of that. So basically, had the talk with my wife. We mortgaged our house, pulled out a home equity loan, and the way I thought about it is like, people basically buy a house, and it's like a 30-year bet on like basically real estate, right? And like their whole investment is real estate. But it's the same. It's like it's the same as if I bought my house that day in 2019, as opposed to before, because it's exact same thing as me selling the house, buying a new one, right? When you pull out the equity, then I thought, okay, what's the additional monthly cost? Like, say the additional monthly cost is $1,000 or whatever it is. Can I handle that with my salary job? Yes, I can handle that. So if I'm wrong and Tesla goes bankrupt, I can handle that, And basically, right. I viewed that as a salary cut. So many people in Silicon Valley, they're taking 15% salary cuts, like huge salary cuts already. So I'm essentially saying, what if I just got a higher paying job, and my salary cut was I got a bunch of Tesla options? I'm basically doing a lower risk way of doing exactly what everyone else is doing. So it sounds extreme that I pulled out the home equity loan, but I thought of like all those different scenarios. I thought of the way I view investing, and how to allocate when you're young versus old, and on all those things. And it just seemed like it made sense, whether it worked out or not. And of course it worked out, but yeah, so that's how I viewed it.
What I really like about that is that's a really cool way to think about the stock market in general. A lot of people have to go get a job at Tesla to get those options, right? If they want that as part of their employee comp package. But you, because it's on the open market, you get to say, well, I want my comp package to look like this. It's 80% Tesla, 20% whatever else. And you get to dial that up and down over time. And that's flexibility that employees at these individual companies don't even get, right? Like, so you kind of get the best of both worlds. You get to turn up and down that exposure, and you get to choose from multiple companies. That's definitely one of the things that I love about the public markets, for sure. So that's a really cool way of thinking about it.
But why don't people why don't enough people think that way, that this is a different style of investing? Like, this is something that I wish more people thought about, like whether it was right for them or not, and yeah, that's why I wanted to start Volt.
You came to the right place, right? Like one of the things we're trying to do on this podcast is explore and expose people to these kinds of new ideas. I certainly wouldn't have thought about it like that before you said it. So hopefully everyone watching this is going to pick up the same thing. Like, oh, it's not just trading money for stocks. I can start treating myself like a Silicon Valley employee in all these companies, except I have all these extra options. Actually, speaking of options, I think that's a good segue. You talk a little bit about like the way you decided to ramp up your exposure to Tesla and how you think about it. Part of your funds also include these options. Can you speak a little bit about how you decide to over or underexpose a fund to a given stock, to options, to cash? How are you managing it sort of at the fund level?
So, when I was investing in Tesla, I didn't just do like 100% stock. It was with a little bit of options and a little bit of other stuff. And for a big portion of that run up, I was actually in cash because I was trying to start the ETF. But if it was actually invested in Tesla, it would be even more. But basically that options helped me because it was a useful tool because I still had the exposure to the upside, even though I wasn't fully in Tesla the whole time. I could still outperform Tesla. And options are just like such a powerful tool to do that. And I really like them because you can bring that mentality, that asymmetric mentality into the investing world. So for that fund, our Tesla, autonomous driving strategy, we basically think about what is the chance of autonomous driving happening. So our thesis is that if people just on electric vehicles alone and just on their profit margins and all that stuff, if right now the majority of the valuation is baked in because of that, we think that there would be a realization in the markets if they think, okay, they are actually going to bring autonomous cars to the world. So we might say, hey, like, is it going to happen this year? Maybe not. So we'll just keep like 5% here or 10% here, and then we just say, okay, is there enough power in here? So like on our site, we show the overall exposure to Tesla, which is like the notional exposure based on the options. We're currently at 150% notional exposure, even though the options are small, like they're like 5 or 10%. The power of the options reflects whether we would, capture a very sharp run up or not. But it is definitely a different style of investing. We're not going to follow Tesla one for one. That's not how it works. But basically, if they hit autonomy, if these crazy disruptive stuff happens, the way options work is that they will kick in, and like suddenly something can happen that's very asymmetric. It's not I don't believe in like leverage, like just pure leverage, because then you lose twice as much as you make. Like you might make twice as much, you lose twice as much, but in the end it's like that can be devastating for any portfolio. But we're just thinking of the end goal in mind for the autonomous strategy, and our North Star is autonomous driving. And
Given that's the North Star, autonomous driving, we got to ask you about robo-taxis. The biggest barrier I see to that thing, because honestly, it's an insane idea, the fact that these cars would just start driving. I know Cruise just started in San Francisco, and they actually went a little well a couple days ago. But the biggest bear argument I heard against that is in India, if you've ever been to a really highly dense, like people don't even pay attention to the stop sign. Literally, we were driving up this way on the highway, and there was a car coming at us, and they just swerved. Like, there's no lanes, right? So, like, the idea that the AI or the AGI could become that advanced in that part of the world, which is where a lot of the growth could happen, and it could sustain a self-sustaining fleet of network of cars, it seems kind of hard to think of. But again, that's kind of the bet on Tesla. So do you think robo-taxis will develop in more of the developed part of the world, like North America, Europe, and then expand? And how do you think regulation kind of fits into this thing in order for that super bull case to happen for Tesla?
Yeah, I think that's a really good question, and I think that it doesn't have to be solved in those areas of the world for it to have a deep impact on stock price. So another consideration is if if a robotaxi takes a certain amount, like say $2 per mile or something, but someone can take you on one of their motorbikes or something for $1 a mile, then even an autonomous car may not actually make much sense financially in those countries, and it won't have like this huge impact. Even if it was just the U.S. though, it would have a huge financial impact, because if all these people who are going into work are instead either working more and coming back earlier, or just relaxing and watching TV or whatever, it would just, like, the amount of time that would free up would just transform society. And it's a lot more than the market cap of Uber, because market cap of Uber is like if you pay $20 or $30 for your trip, that's totally different than paying $10 for your trip.
Right.
You would just go around everywhere, like you would order food from everywhere, and like it would completely change the economics of everything, and that's kind of the definition of disruption. So in these developed nations, Europe and the US and that kind of thing, we think there's plenty of addressable market for them to solve that. On the other extreme, it is true, you can't have a total chaos and the computer knows how to deal with that, but at the same time, like, people are saying you're not going to have autonomous driving unless you have smart sensors, and the traffic light tells you exactly what's happening and whether it's going to turn green or not, and every single car is like connected to the internet. Well, if you do that, then it's never going to happen. Right. It will take like 30-40 years, and they're right, but that's not the way it works. If we are able to drive right now and we're just using our eyes and our ears, then is it possible, just from thinking about it from a first principles point of view, is it possible for a computer to also drive? And we believe yes, through machine learning and AI. So with just cameras, you can technically drive better than a human, as long as the AI is trained and it can, get enough edge cases. I think that it's just a matter of time before it'll be better than a human.
Yeah, I think that's really a no-brainer too. I think there's multiple advantages there. For example, humans have 2 eyes, they face forward. A Tesla can have 8 eyes all around the car with overlapping fields of view. So, they win just because they can look forwards and backwards at the exact same time, for example. But then you can also add in like better processing from all 8 cameras, and now you're doing things like understanding where everything is relative to you, even as it passes by things that like occlude your vision, that like stop you from being able to see it in the moment, and do tracking better than a human with memory can, right? So like, I definitely agree that you can do it with vision only. I definitely agree that you don't need expensive LiDAR sensors or even radars to get it done. What do you think about if the autonomy part of Tesla never pans out? Do you think that their scale through the gigafactories, their lead in energy with their batteries, what do you think about that part of the investment thesis? How much do you weigh them just being the best electric car company versus them truly solving autonomy?
Yeah, so I think that just without autonomy, they still have upside from their current stock price. And that's why we like the investment so much. I had trouble adding other names. Like, people, when Nikola was going up and all this other stuff, I was like, I'm not going to invest in a scam, and I'm not going to these other names, even though they were going up faster than Tesla at the time. But the beauty of that investment, and I think that's why our VCAR strategy has been pretty resilient, is because it is pretty concentrated on Tesla, and for most of the year we were the most concentrated in Tesla if you include the options. So if Tesla might increase slightly just on their electric vehicle and energy business, then that autonomy part is very asymmetric. So it at least provides a floor to the investment that really reduces the risk, that allows us to increase our exposure. And that's the exciting thing about it, is that we think that Tesla is a good business, even like in and of itself, even if it doesn't pan out. And that's why it's even more exciting when the Optimus spot was revealed, because that's another option that's layered on top.
Real quickly, do you have any thoughts on Elon buying Twitter and he's too distracted, or is there any analysis there?
Yeah. I think you can't change who he is, you know? Like, if you just take it at face value and you're really invested in Tesla, you can't really invest in SpaceX. And even if you invested in SpaceX, he's going to spend that on Mars. So it's not necessarily a good investment. But for Tesla, I think it's really good. And, in the end of the day, if he spends way too much time on Twitter, is it going to help Tesla? It's not. But I would much rather have Elon, like a distracted Elon, than anyone else, because you need a visionary to think this way. Basically, he broke all the rules.
Yes.
With SpaceX, people are like, you're going to go against the rocket scientists? Then all the rocket scientists, even Neil Armstrong, was like bashing him and everything. And he basically, they countered everybody and said, these rockets have to land themselves. And even recently, people were complaining, like at SpaceX, that, hey, it's too heavy to put landing legs. And he's like, okay, then can we do chopsticks and catch the Starship from the sky? And they're going to do that. Like within, I think within 3 months, the world will see, this year, they're going to see the first orbital attempt of a ship that can go to Mars for the first time. But I think that was because of the way that he thought. But it's the same thing. Like everyone said before, if you look at the DARPA competition for autonomous driving, the winners used LiDAR. So therefore, what are you doing not using LiDAR? That you're going to fail. And then he thought through first principles, and he said, okay, why did they use LiDAR? Well, first of all, you didn't have billions and billions of hours of footage of all the video in order to use AI in any way. So you can never win a DARPA competition without LiDAR, and without because AI is not going to work. But even though that's the way you win a DARPA competition, that may not be the way that you win the overall goal of autonomy across all streets across the world. So if it's just that it's, if you're a single person coding for like a hackathon for a DARPA competition, there's no way you can like create a strong enough chip or a strong enough server to do that, to like calculate the distance and use AI and all that stuff. But he can, like looking way out, it's like he looked way out and said, hey, we're just going to put cameras, because eventually AI is going to be strong enough. Eventually we're going to have a chip that's strong enough to complete the whole thing, round trip. And he did. And this is something that I totally believed in. It's like, hey, there's an alpha here, or an advantage here, that I came from software. I worked with machine learning people before. I see that if you take this to the nth degree, this is going to solve the problem. But then people in traditional finance, they don't think that way. I have a high respect for ARK. I invested in ARK, back in 2019 too. And I think that's great. Like we need way more people like ARK because there's way too many passives that are looking in the past. But at the same time, even their page had a LiDAR for their autonomous driving thing until recently. But when we launched, like even when ARK had the autonomous driving like little LiDAR thing, we were all in on Tesla. We have very strong conviction on the tech and on the approach from an engineering point of view. And that informs the way that we invest. Our type of research is very different, right? Because if you are looking at PE ratios and like just the financials in the past, that's not going to tell you if the tech works out or not. Like
that's right.
Whether you need LiDAR or not, like it's not going to tell you that. So, if it's a disruptive company, the past is not going to tell you the future.
That's the whole point of my channel, for example, is to evaluate the technology, not just the investment, because there's so many hidden things that you find out by looking at the technology first that only gets monetized once it's already fleshed out. But if you can catch things in their research and development and prototype phase, you have a much earlier view into the future of a company. Like, for example, by the time the financials kind of washed out, everyone who already understood the technology already knew it was a no-brainer that vision-only full self-driving was possible. So yeah, I definitely really appreciate that, like tech-forward research followed by understanding what that could mean for the valuation over the long term, right?
Yeah, and I think
really
that's
cool.
awesome. Like we need more channels like the channels that you guys have to talk about that, because there's not enough of that in the finance world. It's a new world. Like tech has changed everything and will change everything. I mean, just another example is Netflix. People were saying, "Hey, Blockbuster Online is going to happen," and you're going to get rocked online and all this stuff. But they're also saying like, well, I think DVDs are better. Like, why would we invest in Netflix? It's not really the future, right? But if you really thought about it from this kind of thinking, you would say, okay, why are DVDs better? Because you can't get a good enough image quality. Why? Because the internet speed's too slow. But then you look at the trend and you say, hey, it was super slow and it keeps getting faster and faster and faster. What's going to happen in 5 years? It's going to be so fast. Are you even going to drive to a Blockbuster? No, Blockbuster will go bankrupt. So like that's the type of thinking. Like if someone thought that way, it would be life changing, basically from an investment point of view. So that's the kind of thinking. Like I love it. Like I love that you guys talk about it. Like I love that we can talk about it. And super excited about thinking about companies in this way.
For sure.
One thing. Go ahead, Alex. You got it.
No, so talking about life-changing investments in companies, one of your other funds is focused on Bitcoin, right? So can you walk us through? Oh, go, yeah, feel free.
Yeah, Bitcoin. I mean, that's the question. What do you think? I mean, it was at 69K, now it's at 20K. It collapsed over the past week. I mean, obviously the price of it is irrelevant if you're truly, if you truly have conviction over the thesis of it. But like, what role do you think Bitcoin plays in society? Do you see it being here over the next 10, 20, 30 years?
Yeah. I think, even me personally, I wouldn't put 100% into Bitcoin or anything like that. That would just be not good risk management from my point of view.
You wouldn't do what the Dogecoin millionaire did? He made $1 million off 180K, but he never sold. So now it's
Yeah, exactly. I mean, like people could argue, well, you did that with Tesla. It's like, no, it's not the same. Like it was very asymmetric. Like if you look at the type of investment it was, but for this, it's like, yeah, it can be asymmetric, but it's more of like an option that it can go down a lot, like for crypto. But does that mean it's worthless? No, I don't think it's worthless. So can people have a portion, like, crypto exposure in their portfolio? Yeah, I do. And I think that's could be reasonable. What could it bring for the world? There's a lot of things. Like, yes, one thing is it could become digital gold. It could be the backbone for a new economy. It's the one thing that is actually fighting against what has been around for 2,000 years. Is the government keeps basically printing money and the inflation that we're experiencing right now. On top of that, you can also think about what it does for developing nations. I don't think people are talking enough about that. I don't know the exact number, but there's definitely millions and millions of people that are unbanked. This is first principles. Like we're doing the same thing that we did with Netflix. When you walk into a bank, there has to be a person that processes that thing. There's paperwork. It goes through all these people, and then there's a very expensive real estate, which is the bank, and you need a vault, and that's very expensive, and all that concrete is very expensive. Then if you think about it, the only reason why it makes sense for you to put any money for the bank is because you're going to put a lot of money over your lifetime. So if it costs like the bank, $100, $200 to even like have you deposit $10, then no wonder like half the world doesn't have a bank, right? But then if you think about it, what happens if you don't have a bank? Like you're in a poverty cycle. Like people constantly rob you. Like you can't create a vault, then what could be a potential solution to get out of that poverty cycle? Basically, you can have the most secure, digitally secured token digitally without having people involved. It's so much more efficient. Just like many other technological innovations, you don't need people to process the paperwork to say this is credited to you. Then just forget the price of Bitcoin right now, but it's like just that concept is coming and it's here in the form of Bitcoin. And you can say, hey, do I believe in this concept? Do I want to encourage this and invest in the future? Do I want a piece of that as part of my portfolio? And I think some people would say yes, and that would be appropriate investment in my view for some people. So that's the way I view Bitcoin. Like I don't think it's correct when people say, oh, there's there's no value at all, or like, just because there's not a company and they give dividends that it's worthless. Like that's not true. And yeah, I'm excited to see what happens on the blockchain. Like there's all these applications that can happen and a lot of tech that can build upon it. So I'm overall bullish on Bitcoin on a 5 to 10 year timeline. Like even VCs, like they don't think from like year to year. They think from 5-10 years. It's and you see amazing things that happen. Like if you just think about the iPhone in 2007, that's nothing. That was only like yeah, it's like no time, like 15 years. But it's a completely different society that we see today. But if you zoomed in on those initial years, like the first 3 years of that, nothing happened with Apple stock. No one realized that, like, how big of a change it was to have a screen. And I think that yeah, that's the exciting thing about investing the way that we do.
You can see the end game.
Yeah, it's kind of like a video game.
So thank you, Tad, for taking the time with us. Our last question for you today is, do you see an opportunity for new funds from Volt in the next coming 5-6 years? And what would those funds focus on if you do see any opportunities for those funds?
Yeah, like what types of themes that we're really excited about is one is just like the digital nomad experience. So I think one thing is people have only gone one step, which is, hey, COVID happened, you're going to work from home, and that's it, right? We view it as like a flywheel effect. So if people have tasted what it feels like to be either hybrid or remote, even if that goes from 1% to 10%, that has huge implications in the stock market world. And it's not just work from home, because if you were right next to San Francisco and you're living in San Francisco, and then now you can work remote 100%, I doubt that people would not feel the pull to move somewhere else where it's like a fraction of the standard of the cost of living, and they still get the similar salary. And they would even take like a 10% salary cut if that means that they can cut their cost of living by half. And what is the implication? That's basically work from anywhere. Like recently, Bali did a work from anywhere visa. So people can live there for up to 5 years with no tax implication, and you could just live there. So all these expats can go to Bali and use the internet and work from there, like sipping pina coladas by the beach. And that work from anywhere movement, I think, will probably play itself out in the next 5 to 10 years. We've already seen that trend happening with what the Airbnb CEO has said. Before, Airbnbs were used for travel, but they're increasingly finding people who did something that they've never done before, which is stay at Airbnbs for months. So people are like hopping around the world, living there from like 3 to 6 months at a time, and trying out different countries, different areas. So we're analyzing and thinking about the impact of that, what that means for companies, what that means for stocks, remote, and constantly trying to see like what the implications of those are, from a first principles point of view. Definitely, we still have ideas on other themes we can get into.
That sounds like a really interesting real estate play too, right? If I'm looking at cost of living and where people might move, I'm going to think about where real estate's about to get more expensive, the Texases, the Floridas, places without tax, for example. That's actually my story. A few years ago, I moved from Boston to Florida because I realized I had a remote job and I could work from anywhere. So I did exactly what you just said. I took a slight pay cut, but I drastically cut my cost of living. And that's an obvious trend that I think you're spot on.
Basically, it's filed, but we can't. I mean, it's up to whatever the SEC wants. So I'm not saying that it will. That's exactly what's going to happen. But I'll just say what was filed was we wanted that exposure in the form of REITs, and we wanted to invest in the real estate that would happen for that exact reason, right? Because why would you get this super high California tax rate when you can go to a lower tax area and still have that salary? very interesting theme.
You still live in the Bay though, right? You still got love for the Bay Area?
Yeah. I'm still in the Bay. Yeah. Yeah. For right now, it's there is a lot of tech here. We definitely prefer this from from Volt's point of view than New York, because there's a lot more tech companies here. But in general, yeah, I mean, we're not necessarily tied to this area. But yeah, for right now, I'm here.
That's our podcast, everybody. Thank you, Tad, for being the first guest on the Catalyst. This was absolutely amazing, and running us through all your theses. We know a lot of people that watch the channel, they care about a lot of the stuff you're talking about when it comes to disruption, innovation, and actually thinking from a different perspective. So really appreciate you sharing your insights today.
Yeah, my pleasure. It was great talking with you guys.